Good afternoon, everybody. Thanks very much for joining us here. Really interesting session, looking particularly at the logistics sector, the outlook for the markets, and taking a deep dive also into the very interesting UK market here. The session today is just going to look first of all in terms of the research presentation with Tobias Kassner, Head of Research at GARBE, looking at the pyramid research and also what that means in terms of the outlook for the sector. And then we'll pick up on the UK and also European opportunities with Peter as well. So fascinating session that we've got. For those who don't know me, my name's Richard Betts. I'm the co-founder of Real Asset Media. And we obviously publish a flagship publication called Real Asset Insight, but also focus on FDI flows as well as ESG and social impact. All really interesting areas, also driving a number of the sectors, including logistics. But let's just start with you, Tobias, if we can. It would be great to get an overview, and I'm really interested to see this because I know the pyramid research is something that you've been maintaining for a while, so it's great to get that update and this kind of consistency and interest between each of the 6 monthly research sessions as well. So Tobias, over to you.
Yes, thank you very much, Richard. Happy to we'll talk about the, I guess, 6th edition of our pyramid map. Well, very interesting time. We when we started with the pyramid map, we we were on a totally different market cycle, but I guess we can at best hop into the details of the slides to just give you an overview of the key takeaway about what is happening at the market right now. First of all, maybe you don't know GARBE too well, so I brought just one brief overview slide. And this is explaining why we started to create the pyramid map, because when we started to enter a pan-European logistics and real estate approach, covering all the major markets in Europe, we felt it was necessary to go into the details about over 100 markets and explaining how the market dynamics are and what is happening at the markets. And as you can see, we already have 16 branches all across Europe. I mean, we are not only providing development, we have and fund management and investment management and real estate management. So we're really conducting a 360-degree platform here with already over 6 million square meters of logistics space. But going into the details of the market developments, here is what we're talking about. This is our pyramid map, the current edition. It's when it comes to this webinar, we only show it once and then go into the details about the market dynamics. But you can download it on our homepage. There's also an interactive digital version. You can subscribe if you want to our newsletter, so you'll get the news editions automatically in your inbox. And it's covering, like we're showing here, over 110 markets in 23 different countries. And we are, focusing on the major KPIs. We are about to launch an add-on, a forecasting system, so we in the future can not only look into what happened in the past or is happening now in the markets, but have a deep insight about what is coming to the markets. Starting with this slide, as you all are aware, what happened what happened to the markets, to the situation we have at hand. Of course, it's all connected to the inflation rate. And as you can see here, we are showing the inflation rates of the Eurozone as well as for Germany, or for our deep insight session later on for Great Britain, for United Kingdom. And as you can see, it's the basic direction is the same, but with different outcomes when it comes to the detail level, and coming to the closer past. It all started already before the Ukraine war started, but after that, the big increase of the energy inflation led to the situation where the federal banks had to increase the basic interest rates. And this led to a total different situation when it comes to the investment volume, the investment mechanism, because of these circumstances. Looking into the future, everyone is awaiting the starting point where the basic interest rates will start to fall. In the beginning of the year, everyone was talking about, oh, maybe when it comes to the European Central Bank, in the beginning of the year, or maybe in the first quarter. But it's becoming clearer that it will take at least a half year before something will change. But as you can see, the consumer price already is on the very steep decreasing path. And when it comes to the producer price, please look at the scale, the axis, it's a different scale on the right side. Then it becomes clear that the inflation rate is about to drop really in a long period and very steep. So the basic situation and reflecting what is happening at the GDP and the economy, the development of the total economy makes it necessary that it will happen in the near future to have a different situation. So what is the trend on the investment market? Reflecting the Eurozone, it is really astonishing that the volume dropped by over 50%. Looking to, for example, in a different asset class, for instance, office, there's a drop of about 60%. It's even more dramatic. But looking at the average for the long period we are covering in this diagram, we see it is hitting the long-term average. So it is really dramatic, but it is not as low as, for example, after the financial crisis. This is because the asset class logistic is really one of the asset classes which is still in focus and in favor of many market participants and investors. And the share of the asset class is really increasing. When it comes to the total of the Eurozone, the average is about 21%. When it comes to certain countries, we have a share about 25%, even increasing. And this comes the cost of office, for example, which on the average had over 40% when it comes to the long term, but is dropping to more or less 30%. In retail, it's similar because of structural changes. And this is reflected by the interest of the investors. This led in the past to a huge compression phase. This is longer than the decompression phase. But if you look at the rates, at the BIPs, we see for the top pyramid logistics regions, as we are calling them, we had a decrease of 110 bips in the past, and in the short period after the Ukraine war, it already increased by 115 bips. The remaining markets, this is smaller ones, but still, when we are talking about the 110 logistics regions in Europe, these are the regions where really the logistics activity is measurable. Of course, there are more, but these are the major ones. But for those second-tier markets, for example, it increased already by 100 bips in a very short amount of time. When it comes to the national level, it's not so. It's more heterogeneous than the Eurozone itself. And for example, we see three different classes of marks. For example, the markets like in Eastern Europe, Poland, where higher net initial yields are still can be measured. Then, of course, the markets with the mature markets, for example, like UK And here we can see, for example, in the last, since the last edition, half year of 2023 until the end of last year, or more or less what is the situation right now, we have only an increase of about 7 bips. So for UK, we can see really hit the bottom or the start of the next investment cycle. This is the same for example, the Netherlands, where we had an increase only about 10 bips. And other markets, for example, like Germany, they are not so fast. It takes a little bit longer for them to really hit the bottom level. We guess it takes 1 or 2 more quarters to reach the same situation as we are having or seeing right now in UK. When it comes, and here we are having a deep dive into the German market. We will cover the UK market and other markets when Chris or Peter are covering their parts. But for the German market, it's really interesting to see that the top markets, like the top 7, Munich, Hamburg, Berlin, etc., we had an increase of about 150 bips. And for the main and the secondary markets, it's much lower, only 100 or 110 bips. So we're having or facing a situation where we have 4.8 net initial yields in the top markets, up to 5.6 in the secondary markets. Of course, like I said, we are at the moment not forecasting any figures. We're about to do in the near future. To fill this gap, we have always a LinkedIn survey where we are asking the question, how does the market see the change? And here we're showing the situation of the survey from the January 2023 and from the beginning of this year. And last year, more or less the same time, many people, or a larger share, said that the yields will continue to rise, that decompression will still take place. This share is a little bit lower, but what is really impacting the situation that over 40, 50% is saying that the yields remain constant. So we are reaching about a stable situation. More people guessing that the next investment cycle is about to start, or the decompression phase is about to end. When it comes to the rent development, of course, the demand of space is one of the major drivers. And for a longer period, this one remained really stable. We're seeing quite strong activity still in 2022. And of course, we are missing the fourth quarter for this one, but still it can be seen, even if we have a smaller chunk for Q4 adding we imagine it on top. It's still quite lower than what we saw at 2022. It will still be on the average for the long term from 2016 up to now, but it's lower. Why is this happening? There are 2 reasons for this. On the one hand, in many submarkets, we have a very low vacancy rate. There's simply no space to rent anymore. So here we have the situation that we can't have additional take-up. But and this is getting more and more important in the next few quarters, the renting companies, the tenants, are facing more or struggling more and more with the recession phase of the geopolitical tensions we are seeing in the world. So they are a little bit cautious about the activity. They tend to stay in their sheds and in their places to continue their rental relationship and not moving to bigger places or even increasing their share. When it comes to the rental development, we can see this development in this diagram. We are having a huge increase all across the pyramid markets. In the top market, it was over 2 euros, facing now 8.35 euros per square meter. And from the second tier market, it was almost 2 euros. So a huge increase, and you can see it's there's the steepest path, or the steepest chunk of the diagram started about 2021, more or less until the last half year, as then starting to decrease a little bit in their pace. When it comes to the biggest and the top markets, there's still a measurable good increase in the rent developments, because many of the still renting companies want to be in the top markets, and their availability, even for plots of land for new developments, as the same for existing spaces, is scarce. When it comes to secondary location, one of the where really high activity could be measured in the last couple of years, because here we are still having plots of lands, we are still having workforce. At the moment, they are a little bit cautious about those areas. And this is in addition to the situation as many, and some of the submarkets, new sheds and warehouses are being built at the moment, and it's not being able to be rented out so fast and in the last couple of quarters. So here the pace of the rental development is slowing down. Again, when we're looking for the average growth rates for the pyramid map, we can see what I just showed you, but in a different way, where we can show that we had on a half-year basis an increase of almost 7% in many of the last periods, and it's now decreasing for the last pyramid edition to only 3%. It will still be, when looking for 2024 to 2024, that the rental increase will continue, but in a much slower pace. But as we measure, still above the inflation rate. For the German market, it's since we have a longer time series, it's you can describe a little bit more in detail. The decrease is 26% to 6.3 million square meter. And for Germany, as well as for many of the European markets, it's a normalization of the take-up. We had really record-breaking levels in the last 2 or 3 years, not only connected, but also connected with e-commerce as a driver. This one was not or is at the moment not the situation. So it's dropping together with a more cautious approach of many companies to a lower level. But as you can see, it's still more or less on the path of the GDP growth. And this one is really connected to each other when looking to the longer time series. When looking into the future, it's not a forecast, it's more or less a projection. We see or still think it's correlated, but we are very cautious to the increase. So the next 2 or 3 half years will be at a much slower pace when it comes to take up. It's our estimation, will continue or start to increase by 2025. And then some of the drivers like e-commerce, which weren't able to participate in the demand in the last few quarters, will come back, because this share of e-commerce, for example, in many countries, it's different to the UK market, is still on the underperforming. There's still a huge growth path, and new forms of e-commerce like social commerce or demand drivers like industries which are coming to the European markets but don't have a logistics service network in place, will start to increase activity in Europe. But this will take a few quarters to kick in. This one is a different approach about showing the rental increase, again, the German market. And here we'd like to point out that in many countries, there's one market, for instance, here it's Munich, which is really outperforming. And developing away from the other huge chunk of the markets. And it doesn't really matter which color is reflecting which market. It's just showing that the markets are very dynamic when it comes to the development, because the place of the different colored dots are changing over time. So the development and the importance of many of the submarkets, and this applies to other countries as well, is changing over time. But still, the increase in the total path can be seen here as well. Again, we asked the panel on the internet, what do you think, what will happen in the next or the ongoing year? Last year, many market participants thought, yes, the rental increase will really be strong and continue over the year, and this is what happened. This year, the panel is more cautious about it, but still 45% of the panel thinks that the rental development will increase over the year, but not as strong as last year. And this, or the other way around, the chunk of the pie of the panel, which is saying that the rents will remain constant, is increasing to 38%. So the last 2 pages of from my side is, what do we think will happen in the future? One of the biggest topic which changed the investment cycle or the volume was, as you are all aware of, the base interest rates and the financial conditions. And we just showing here it with for the long term and the short term financial rates when it comes to swap or Euribor. And when it comes to the forecasting period, more or less all the forecasters are sure it will drop over time. It will not dramatically go down to levels like we are used to before the Ukraine war, but in slow in time, the basic situation will be better. And with this slide, I'd like to pass on or give back to Richard, and thank you for your attention.
Great, thanks very much. Some really interesting things there, Tobias, and we'll drill down a little bit more in terms of the differences between some of those different data points there. I'm very interested to see that where Munich there is an outlier. Interesting to see what's driving that market as well. So fascinating to look at that, and a reminder to everybody actually that on the right hand side of the screen, you'll see that there's a chat area there. So if you just log into the chat area, please do ask us any questions that you've got, and we'll make sure that I bring those out and we talk through them in the discussion as well. So do put your questions in the chat. I just wanted to pick up with you, Chris. Obviously, you're their country head and MD of the UK for GARBE. It would be interesting just I suppose to pick up, you know, there's a lot of commentators who are, you know, very upbeat, I think, on UK logistics investment for this year 2024. So it'd be interesting just to get your take on that and where you stand.
Richard, and very good afternoon to everybody. Yeah, it's probably the $1 million question I'm asked right at the moment. Where are we exactly in the UK market? In short, I'm actually very positive currently sitting here in London, and I'll, you know, the next few minutes I'll just drill down as to why, to give that a bit of credence. If we take a step back and look at sort of the wider picture, the macro, and where we've come from, yeah, 2023 was a tough, you know, brutal year in the logistics market, in all honesty, in the investment side. Interest rates, they went to the highest level 15 years here in the UK, and then link that to swap rates. They had a pretty dramatic spike, around just after that. Inflation, that was running high, but now that's coming down, delighted to say. And then also you can't look away from, we got elections as half the world's population coming up this year, but in the UK. But do I feel that's going to have a dramatic impact? You know, I'm not going to get into the politics of this, but I don't think it's going to have a massive swing in terms of what's going to happen as an impact, which result comes through. But now bringing that down, bringing it to where we are actually here in the UK and looking more into what the actual logistics, for me, whatever time, whatever cycle, it really is down to occupier demand. If you don't have tenants, you know, for us as investing, for us as developing, it's a no-no. But here in the UK, as much as Europe, and Tobias has touched on it, but for us in the UK, we've had a huge structural change in the logistics market. E-commerce, UK, we are the third highest e-commerce penetration in the world. Okay, it has dropped down from the COVID levels, but we're still 26% currently. By 2028, that's predicted to go to 30%. Then nearshoring, that's become Brexit, and also, unfortunate with the events of the geopolitics, etc. That's raising its head again, and it's going from sort of just in case to just in time. There's a lot of speak I hear from the occupiers who we speak to, and then you can't get away from urbanisation. The sort of major food operators now having these 1 hour time slots for deliveries, and so that's putting huge pressure. So a big struggle push there. But I think probably a good time if I've got a slide actually, which I think is quite useful to show. The sort of key point for me is take up. You can see here the 2023 figure, which has hit a few headlines this year. Commentators are saying it's 30% down this year, but in all honesty, we were always going to be down. We've had 3 stellar post-COVID or COVID years, which I don't think we're ever going to achieve those levels again. So when people say it's a dramatic drop, it's a dramatic drop, but it's actually coming to, you can see the green line there, which is the average of pre-COVID. So in reality, the actual figures we had for this year were ahead of where I thought we were going to get to. And when you sort of take a sideways look and see where that demand was coming from, here in the UK, we've actually got a good spread, which is what I like. We're not just dependent on one occupier. So manufacturing sector actually has seen an increase here in the UK over 2023. And it's actually probably being, okay, specific to regions, it does differ, but it's very much a third. We've got manufacturing as a third, 3PLs as a third, and then we've got the e-commerce retailers as a third. It's no secret, Amazon, they disappeared from the market, but giving a bit of sort of jab in the arm confidence, Amazon came out a couple of weeks ago taking 2 million square feet, although it sounds in a footprint that's huge, but actually they're doing a 3-story 700,000 footprint. And then also we've got down in Kent, in Aylesford, Tesco have just announced 620,000 square foot. So what we've seen, and we've seen the likes of ASOS and Boohoo, yeah, they're fashion retailers. They've had their downs and they've had to move out of some quite large chunky units. But now what we're actually seeing again is an uptick, which I see that as a very, very positive signs. The UK market always historically has got constrained land supply, and I always, when I speak to my German colleagues, Germany 1.5 times bigger in terms of land mass. UK population, German population, I think it's 18% big. So we're squeezed in, and linked to that, the planning constraints, etc. It's always a tight market for us. I can't hide away from vacancy rates. Vacancy rates here have jumped. They were ticking along at 2.5–3%, and now at 6.5%. Am I concerned about that? I'm not actually dramatically concerned. It's jumped up because we had a lot of spec development, which the take up hasn't been just sort of consumed. We had 18 million complete in 2023. Having said that, a third of that has already been let. What we have actually seen is the existing occupiers in older space moving out and leaving that space, which has caused a spike in that. I'll come on to the ESG piece because that's partly driven by the ESG. The issue for me here now is just the scarcity of evidence in terms of deal evidence. And I think that's probably a good time to bring up the next slide, because you can see here, and I'll just get that on my screen as well, so I can just talk you through it. We had right at the time where we got down to sort of just over 3%. And as Tobias said, the UK, when we look at our research and data from the GFC. The UK market moves the quickest. It's greater, well, not the greatest transparency, but it has a lot of transparency, fluidity to it. And this time around, it's a gain. So it's been very much the V for the UK market back in the financial crash, and here it's exactly the same happened again. Literally, the Ukraine war, we're down at 3.1, and now we stabilise again at 5.5, and we're just seeing it moving back in again. And it is the first of the European, Western Europe markets. So where I am now, I'm calling prime at 5.25. In fact, actually, some locations are going to be even sharper. 3 deals that spring to mind. We've got Leicester Distribution Park, which is under offer, Viva Investors. 8 units, 8 tenants, a WALT of just under 10 years. Net initial there of 5%, which on reversion is going out to just 5.2. And then we've got Warrington, Omega 2 up there, which has got Amazon and Gusto. Again, another 100 million deal, but 4.8% moving out to 5.5% in 3 years' time. So for me, when we look at those deals, it's very interesting because also I'm aware now in the last month or so, 3 large funds being set up, looking for core plus money. And core plus money here in the UK, as it has across Europe, has gone very quiet. But seeing these signs of 3 large funds explicitly, not just in logistics, but in other markets as well, of being, sub just under $1 billion each, that's a lot of firepower to come. And so it's literally just a scarcity of product at the moment, which is holding that back. So all in all, it's linked with the availability of debt as well. Actually, that's probably a very good point here in the UK compared to when I speak to my colleagues as well. Debt, not necessarily the high street lenders, because that's changed that whole profile, but the debt finance, debt fund, that is still there, albeit at lower margins or high margins and lower LTVs, etc. But availability of debt is there, and that really is the drive for me. I put the caution is, where do we actually see it going over this course of the year? Okay, inflation coming down, interest rates. It really is, when do interest rates actually do come down? Swap markets, I'm looking today, over the last 6-8 weeks, it has come down dramatically over 50 bips. But if that was to change again, that would obviously put a bit of a break on it. But where I am here, I'm very, very positive in answer to that question, Richard.
Okay, good. Interesting to hear that kind of positive take on it, and absolutely right here. Of course, the majority of market commentators are expecting interest rates to begin falling and moving forward in that way. And interesting to hear as well some of those bigger deals coming into the market, which does, I think, provide an interesting take on it. And Peter, you're obviously looking after the kind of fund management and capital markets side across the business. So it'd be interesting to pick up from you, I suppose, what you're seeing in terms of particularly some of the other areas where GARBE is active.
So thank you very much. So we think, as Chris said, UK is setting the trend. And if we look in the past, we see, let's say, relatively same cycle curves in the different countries, maybe despite the smaller Eastern European ones, Czech Republic and Slovakia, I will touch on later on. So we see the same relative. In absolute numbers, it's different, but relatively, they all, let's say, had the boom times in Corona. They all, let's say, were hit a bit by inflation, and then interest rates are going down, and then they, let's say, had some kind of a break. Yeah, or they hit the wall, whatever, let's say, you might say to it. I mean, and now, let's say, they're all facing a bit like the declining in demand. I mean, it was, let's say, the idea of cooling down the economy by raising the interest rate. So it's not a surprise. Yeah. So, and if I look to the UK, I mean, it's the first mover. And from our perspective, if we look at Spain, it's a bit like the one who's just, let's say, sticking a bit, let's say, where the UK and maybe the other were 6 months ago. So we see, let's say, every 3PL, especially DHL, I mean, it was a press today in Germany, stopped a bit the expansion. They stopped, let's say, every plan, and vacancy rates in the Madrid area are now, let's say, rising at 8%, and in the first time since 10 years in Barcelona, it's higher than 5%. So there it's a bit still like a bit, let's say, frozen tenant demand. It's getting slower and slower. Financing is difficult. But on the other hand, we will see a positive trend, like in the US, because in principle there's almost no internet penetration compared to UK or even to Germany and Spain. So it will come, but it will be later. So let's say if UK, let's say from our point of view, is that's at top of Europe, Spain might be, let's say, the slower one. France, for example, let's say it's I think it will be closer to UK than to Spain. We see, let's say, financing is positive. The third speculative development will start. Investment market is coming back very slowly. I mean, in all Europe, we see, let's say, a drop down of 50%, even in logistics. In Italy, for example, logistics was, let's say, the asset class better than office, but in relative numbers, still just 50% of the others. So coming to France, we see a small shift from the main route from Paris to Marseille, a bit to the Atlantic, but positive signs, especially on tenant demand. They're asking for financing, let's say, is possible even for speculative things. So there is a bit like some smell of getting better without being in the status as UK. You smell it, but you can't see it somehow a bit. If we look at Italy, I mean, Milan is always, let's say, the place to be. We have, let's say, a more robust tenant demand. Again, a bit comparing to Spain, almost no real internet penetration. We have still a demand from the typical 3PLs. It slowed down because, let's say, of the shrinking economy, but it was not, let's say, on a bit level like for example in Spain. And we saw, let's say, in the fourth quarter last year, some positive things on the investment market, always having in mind, let's say, that the big bunch of core buyers were, as Chris said, very silent. This is a very polite British wording, yeah, that we almost disappeared, let's say, from a more straightforward German perspective. So almost every transaction were, let's say, a bit core product, but bought by, let's say, core plus or value add money, which, let's say, dropped a bit the pricing again. So, but we see, let's say, still some kind of a robust thing in and around Milan. If we look at Czech Republic and Slovakia, small, they have, let's say, almost no vacancy, 1%. They, let's say, absorb, I mean, a bit, sometimes a bit more than they're produced. We are concentrating on, let's say, in Czech Republic, on Prague or on the German border, where, let's say, the advantage is that, let's say, a lot of, let's say, German light production went across the border. It's a bit, labor force is a bit better and a bit cheaper. So there is, let's say, maybe for a small country, a bit like a very specific trend. Financing was always a bit more difficult. So you have roughly 50% pre-leased for developments. And since the Ukraine war, we have, let's say, for the typical Western Europe capital, they thought it was, let's say, close to Ukraine border, which is not. Yeah, but there was the time, besides the economic pressure, it was a bit like some emotional pressure. Oh, it's very, very close to Moscow, looking from a, let's say, Western European perspective. It's a bit more emotional than factual driven. Poland is a bit different. If we compare Poland with the Netherlands, the decisive thing is we have 18 million inhabitants in the Netherlands and 40 million of stock. In Poland, we have roughly the same stock, the same square meter per capita. So it's still, let's say, 50% less comparing to the Netherlands. So therefore, we see, let's say, a positive, very, very positive future. The market changed a bit. Vacancy is going up. Financing is quite more difficult to come. Exit market is quite difficult. It stopped a lot of the typical speculative or very aggressive developers. So new product, let's say, is coming very slow into the market. And you have to have in mind, the oldest stock is from 2006. So it's a total difference, say, to Western European markets, which established, say, 30, 40 years ago, which, let's say, really old stock. So we see a positive trend at, let's say, the industrial hearts of Poland, but it need potentially a bit more time. There will be the same Western European topic of scarcity of land, of new industrial land, which we haven't seen in the past. So there will be, we think, a typical Western European trend. And as I've said before, there's a long route to go, let's say, and then it's a bit like, say, how you see Poland is, let's say, if you look at the east and west connection, let's say, is it the exit to Europe or is it the interest? So we will see. It's a more geopolitical question whether it's some kind of a hub like the Netherlands for all the goods coming through the Atlantic, some kind of a door opener, or it's a bit, let's say, in the end of, let's say, where all the goods will be delivered. If we look at the Netherlands, I mean, it's a purely logistic hub. If you drive through the motorway, I mean, it's all logistics. It's, let's say, size-wise, a small country. We see a specific Netherlands trend regarding pricing. They went up, let's say, a bit more down than the others, which relates to the red system in the Netherlands, where in the first 6 months of use, you don't have to pay right now that 10%. So every developer sitting a bit, let's say, in a market where almost no core capital was there, trying to sell the asset in the 6 month period, and let's say offer potentially 8.5% or 9% discount, let's say, not to face it. So we have seen it. We still see in the Netherlands that the demand is not there as it was before. But let's say, as we have seen in Tobias' slides, it won't be, let's say, on the Corona level. So if we just all compare to these maybe special times, we have, let's say, a very negative trend. If you see, like Chris showed, UK, if you have the 5 or 7 average, it's very there. It's there. So we still see, let's say, positive trends on demand. They will come back when let's say, the inflation battle will end. Might be this summer, might be this autumn, might be beginning of next year. Interest rates will, let's say, a bit going up, and then the demand is there. Still, it's a positive asset class from our view across Europe.
Okay, interesting to hear that. And I suppose, I guess the interesting thing really is, let's look at timing for investments into the market, maybe. I mean, Chris, from your point of view, obviously, if you're beginning to see almost a bottom or a turnaround in the market, let's say in the UK, does that mean that, you know, you're expecting there to be more investors coming in at this stage? How do you see that?
Yes, we do. I think that the biggest issue actually is the one which I touched on, is the sort of lack of stock, and also price dislocation. This is what we've been seeing for the last year, 2 years, on both the development side in particular and also the investment side, is that trying to get that combination of where the typical I'll sell at a price which is matching where a buyer expects, and when the two meet, that's when the market gets greater fluidity at the moment. But we've had a period where we've had base rates, interest rates have now come down to 5, the net initial yield and the borrowing rate are very similar. So you got growth potentially at 5%. So the actual rationale for a vendor to sell isn't really that tempting. However, the outlook for the 24-25 here in the UK, and it is across Europe, is that we've got issues with one, funds have got redemptions, 2, we've got refinancing in terms of borrowing, term loans are coming to the end, and we've probably got covenant breaches. So I'm not saying it's not going to be end. Well, my belief is it's not going to be anything like we had in the financial crash in terms of sort of distress, but there'll be pressure, and from that I definitely see we're going to have more activity on the investment side. So what with the attractiveness here in the UK, definitely on the up, and 2, with that greater fluidity coming into the market, I do see much greater activity. And you can be seeing, coming back to that point, the core fund, there's core money coming back in, and those some have done very well and bought very well over the last 6 months, because quite a few of the funds have already had to sell some assets. And we'll look back at those in 6-12 months' time and say they were cracking deals, and that always happens in markets like this.
Okay, good. I'll come to you in a second, Peter, but Tobias, I just wanted to pick up with you in that sort of position where we've got inflation coming down, we've got interest rates potentially coming down. From a macro perspective, I guess, what's your view on how that, you know, will influence, or the implications for the logistics real estate market?
Well, I think what a good way to describe what happened in the last years is the term polycrisis. We have a lot of different drivers which is changing the demand or changing the circumstances for the market. And for the next year, and like I told it, and my two colleagues mentioned it as well. One of the drivers was not in place. It was e-commerce, and this will come back in the future. If the I think it's necessary for that because of the declining inflation rate and the recession, it's the worst situation in Germany, but for the Eurozone in general, it is necessary to really reduce interest rates to get the economic going again. But it will take some time because the ECB or the Bank of England, I guess, will be, or today I think they announced the interest rates will stay the same. So this will take some time before we can see any major reaction. Usually it takes about 12 to 15 months to have a reaction on changing interest rates. So I guess the situation will be lower for the time being for 2024. It will start to kick in by the end of the year, maybe if the interest rates are going down, and then kick back on a larger scale in the next years. What is happening on a geopolitical view? It's quite interesting as well, because at the end of this year, there are elections, or a large part of the global world, the total world, is having an election this year. So this will could have a major impact of how the global trade systems, the supply chain is working. And I guess there are many threats for all economies, but also as many opportunities when it comes to Europe as well, because we already heard the term nearshoring. I guess it's a term we heard quite a lot in the past, but I think when it comes to sea routes, for example, what is happening in the Red Sea at the moment, and this is the second time in the last couple of years where we have problems with the goods being delivered from Asia to Europe. So it's quite expensive to take a huge route around south of Africa, especially when it comes to cheap products, not as much as high for electronics, for example. But I think many of the companies will continue to think about shortening their supply chains and come back to Europe. And for a company like GARBE, which is following a pan-European approach, is quite interesting because there are many possibilities everywhere in Europe. For example, Eastern Europe, where the labor force is still available and very cheap. Many of the producers will seek possibilities there. Then, of course, we have the blue banana, the big economic foothold stretching from Manchester through London, then the Western European countries, then to Milan, and a little bit further to Spain. Then we have big parts where many inhabitants are living, for example, with a high density, like the Netherlands. So there are many possibilities when it comes to the production side, to the consumer side. And this is still something which is developing right now. So many opportunities available for the next years, but all connected to some of the key drivers we're all waiting to change.
Yeah, that's interesting. And Peter, from your side, I suppose, how are you seeing those opportunities, and what's the kind of time horizon that you're seeing for the different markets? Because obviously they're going at different speeds, but are there particular cities, I guess, that either the macro position in terms of some of the nearshoring trends or changes in terms of transportation links and those kinds of things that are driving it? Well, I suppose, where are you seeing the biggest opportunities at the moment?
Yeah, I mean, so I would, let's say, and I think I said it in this around last year, still, let's say, Czech Republic, let's say, from our point of view, is a place to be. Yeah, because as long as we have the difference between Germany and Czech Republic on employee earnings, there will be, let's say, a shift there. And if you concentrate, let's say, on Prague or there, it's there. But let me come, let's say, to Spain, which, let's say, I mentioned a bit, let's say, potentially the one who will recover, let's say, less faster, maybe, let's say, slower than the others. If there's an opportunity in and around Barcelona for 5.25 or maybe 5.5, I would do it immediately. If it's leased out for 10 with a good covenant for at least 5 years, you can't be wrong. So maybe you miss the bottom. Maybe there will be, let's say, another 25 bips going up, maybe. But we're all thinking about buying at the cheapest, selling at the top. Yeah, that in theory, it's great. But let's say if you do it on a professional basis, typically, if you look back, yeah. So I think if you look at the trend and think that on the long-term basis, might be 3 years, 5 years, interest rate will be below the yield you bought. Yeah, there will two things happen in logistics. The first thing, you have still the rental growth. Might be not 10% every year like we saw, let's say, in the big inflation years, but it will be, let's say, I think, a bit above inflation. That's the one thing. And if interest rate will fall below euro, they have a positive leverage effect, and then, let's say, multipliers will go up again. And therefore, there are the opportunities. Yeah, it's which countries. I think it's more, let's say, the view of the capital. Yeah. So if you have, let's say, the typical core capital, typically is not setting the trend, it's waiting a bit when it's visible, then they will come later. Yeah. If you're a bit more aggressive, but you still, let's say, have it's UK, it's Czech Republic, it will be Germany, and all the others are. I mean, in Milan, if you look at Milan, it's a great area to be. If let's say in the middle of the blue banana, yeah, let's go for it. In France, I would see, let's say, the peripheric area. It's Paris is still very expensive, and the question is whether you have the growth there. A lot of stock there in and around. So this is a bit, let's say, where we see. I think there are the opportunities now. There is still some uncertainty, so we don't think that the more or less shy conservative core capital will be massive on the market now. Even that swap rates are going down, it will take some time. Can be end of the year. But from our perspective, looking, let's say, from a logistics professional basis, even, let's say, if you're not touching the bottom, yeah, I think from today's perspective, it's more, let's say, missing the beginning of the up. What let's say we are seeing as a. I mean, if let's say in 1 year we're looking back, yeah, could be the point.
Okay, good. And I could see that there was certain elements of agreement there, Chris, from you. I guess thinking about the UK market as well. And it would be good just to pick up on the rents a little bit, just in terms of the sustainability of those, because obviously that's going to be a key driver on whether we expect to see those continuing. I mean, you mentioned obviously before that there's a constrained supply, and that will help drive some of those. But will we see things like, will there be a Brexit effect that sort of gradually disappears, or do you expect that to remain in place? What's your sense, I suppose, of some of those supply dynamics and the sustainability of the rental side?
Question for me, Richard. Sorry. Yes.
Yeah.
Look, we've had that's all driving. The key for that is the rental growth, which Peter's picked up on slightly there. We've had last year. Okay, some of the documents, papers, research has come out. It was 7% last year, which for 2023, and I started off by saying 2023 was a tough year, but to still have 7%, albeit inflation was higher. It wasn't at the levels of what we've had before, which have been double digits. But going forward, the estimates are there, and research is all highly confident. We've got spec development, which is albeit come to a very much of a standstill over the last 2 years. So when I'm saying about supply levels, that's going to come down. I think what we've got, an interesting fact, which I'm conscious of time, but is that ESG piece, the spread between prime and secondary rent. That is definitely, in my view, it's in the UK, it's at the highest level at the moment, and in my view, it's going to increase. And this is key for the market going forward. Any investment we look at, you either build it into your business plan or it's already there, the credentials, because I'm afraid the secondary and tertiary stock are going to get left behind. And that's not just for institutional requirements. It's not just from us when we're developing as well, but it's going to become, and it's coming blatantly clear from occupiers as well. And their staff. And, you know, we always hear about ESG, but it's also that S piece now. That is becoming huge. So, yes, definitely the rental growth piece. And that is, whenever we do any modelling, is it sustainable? Is it supportable?
That's become. Are you seeing that as a change, let's say, over the last 12 to 18 months? Do you think that's accelerated, Chris, or
the ESG piece in particular? Yeah. Oh, without a shadow of doubt. And you've got ESG, what I would call those who are doing it properly, and those who are paying lip service to it. And I'm afraid it's getting more and more drilled down, and anything with is up there as number one for us. Right from investment and from development. So if we're building from ground up, it's got to be right up there. BREEAM excellent, or very well, BREEAM excellent nowadays, Article 8, etc., etc. So absolutely, and that is most definitely going to accelerate without shame.
Yeah, it's interesting you mentioned that about BREEAM excellence, because I've had conversations where people have been saying, well, BREEAM good is definitely not good. It's now the wrong description for it.
Yeah.
Peter, it'd be interesting to pick up with you what you're seeing, you know, across Europe on that. You mentioned a little bit that obviously the stock in Central and Eastern Europe tends to be younger, but are you seeing that same, I guess, difference in the markets that Chris is seeing, you know, where you've got sustainable stock that is really being differentiated now?
Yeah, so if you look, let's say, at the European map, it's you have, let's say, the entire variety. So actually, if you look at Eastern European on the tenant market, frankly speaking, actually they don't care. They don't care. On the investment market, now it's coming. Even, let's say, in local investment thing. So everything which is new has to tick all the boxes. But if you look, let's say, south of Milan, 10 kilometers south of Milan, there is no heating in the warehouse. So you have some cooling in the office space. So you're ESG friendly from day one. You have no insulation if you don't have any heating. The only reason to do insulating is if you have, let's say, want to store goods, which should be protected against the heat in the summer. So, and let's say, if we look at this, typically we just have to build warehouses there. It doesn't make sense to do it in Northern Europe, because then so therefore there are different views in different markets. In Spain, it's still that they have no solar panels on top of the roof. An exciting thing, if you look at the US, they don't like solar panels on the roof. I mean, even if the Sun Belt, they're not doing it because all the investors don't like it. It's too complex. Looking from a European perspective, it's total weird because we put, let's say, on all of the stock that. Coming, let's say, to another thing we didn't touch. I mean, we always look at the numbers of new stock on the market. What we don't have, and in Germany, we will have it soon, how much warehouse space will be absorbed by others, maybe a bit higher value asset class like resi or offices. So we will see, let's say, in a couple, let's say, weeks or months or whatever, in Germany, as at the first example, as a home turf, what is the net number? And it will be interesting to see whether it's positive or negative. We don't know. We see, let's say, as Chris said, in the UK, in the entire Europe, is slowing down production of new stock due to crisis times. So this will be, let's say, when we look about demand, and we all know the EU legislation which says in a few years there will be no new industrial or even other let's say zoning for new buildings. So that there's a natural end, and then everybody's looking for these. So where can I do new ones? Nowhere. So I look at the older ones. So therefore we think that even in a long time there is, let's say, more demand in space.
And on that basis, you're going to see quite a big play potentially for value add transformation of some of the older assets.
Yeah, in urban areas, that will be the case anyhow. Yeah, yeah.
Great. I'm conscious that we have 1 minute left, and we've covered quite a lot of ground. But it would be really interesting just to get from everybody. Let's start with you, Tobias. Just, I guess, your overall take for 2024. Positive, negative. What are the key areas that you think are driving the market?
Always on the positive side, I think more or less many of the markets are going to the direction like to the bottom of the current cycle, then starting anew. Many of the signs say, okay, we will have the opportunity to start anew on a very slow pace, of course, but I'm looking more or less positive into the future.
Great, Chris. Let's come to you on that one for the UK.
Yeah, for UK, I think I've covered it in terms of I'm absolutely confident, apart from any major changes in geopolitics or interest rates, that we are at the bottom. And I don't think it's very shared, Tobias, but for UK, it's not going to be a great big acceleration steep curve. It's going to be gradual and surely, and it's going to be those who really have got the confidence and ability are going to pick up the better deals without a shadow. And that happens. I've said it before, it happens in all markets. But yeah, very, very positive here for the UK, which is why we're ahead of the market. It always happens that way, and it will carry on that way.
So very much back to that idea of, logistics specialists in a way, being able to create and drive the market.
Yeah.
And Peter, final word to you. Positive,
Yeah, so,
negative, where are you?
I'm positive. I think economy will come back. Interest rates will go down. The question is whether it will take six months or 12, maybe a bit more. But let's say if I look, let's say on a 2 years. So if we meet in 2 years, it will be there. And then tenant demand will be there. And then we have, let's say, not on the peak Corona, without a doubt, but there was a stable, let's say, and fundamental industry, and it does make sense to be part of it.
Great. Thank you, Tobias. Thank you, Chris. Thank you, Peter. Really interesting to get your views and also the important update on the market. It's always a pleasure to pick up on that research, especially because it's ongoing and it's every 6 months. So you can begin to track some of the changes there, which is what I especially like about that. Thank you to everybody for joining us live, and also thank you to everybody who's joining us on demand. You can access the slides on our website. So just go to realassetmedia.com, find the events page, and you'll be able to download them from there. And you'll also be able to access the on-demand content from there as well. Thank you very much to everybody for joining us, and look forward to seeing you at the next online event. Thank you, everyone.
Thank you.
Thank you.